The year you turn 65, the tax code quietly slips a coupon into your hand. It is worth $6,000. If your spouse is 65 too, there are two of them, $12,000, and you do not have to fill out a special form or hire anybody to get it. You just have to be old enough and be under a certain income. That is the whole catch, that last part. Because there is a line, and above that line, this coupon does not just stop, it dissolves. 6 cents at a time for every single dollar you go over, until one day it is worth nothing, and you never felt it leave. Here is the part that should make you sit up. The people most likely to cross that line are not the wealthy. They are ordinary retirees who did one very normal thing in one very normal year. They converted some of an IRA. They took a big withdrawal for a new roof. They finally sold the old rental. And that single move, the kind your neighbor would call smart, is exactly what reaches into your hand and takes the coupon back. So today I'm going to show you what this new $6,000 break actually is, who really gets it, and the one income mistake that makes it disappear. Because it is real money. It is sitting there right now. And most people are going to hand it back without ever knowing they had it. Let me start with the good news, because it is genuinely good, and it is new. When the big tax bill passed in the summer of 2025, it created something called the senior deduction. Most people have heard a vague version of it. Very few know the shape of it, so here it is, plainly. If you are 65 or older, you get an extra $6,000 knocked off your taxable income. One spouse, 65, $6,000. Both spouses, 65, $12,000. That is on top of everything you already get. And I mean on top. This is not instead of your standard deduction. It stacks. You already get the regular standard deduction, and if you are 65, you already get an extra standard deduction on top of that, and now this new $6,000 sits on top of all of it. Better still, you do not have to itemize to claim it. You can take the plain standard deduction like most retirees do and still get this. You do not need receipts. You do not need a shoebox of paperwork. You do not need to give your accountant a single new headache. There is one honest limit I want you to hear early, because I'm not going to sell you a fairy tale. This is a deduction, not a check. Nobody mails you $6,000. What it does is lower the income you get taxed on, and that saves you real money at your tax rate. For a typical retired couple, that is somewhere around $1,400 to $2,600 a year that stays in your pocket instead of going to the government. Not life-changing, but it is a nice dinner out every month for doing nothing but having a birthday, and it is yours if you do not trip over the line. So who actually gets this? The rule is refreshingly simple. You have to be 65 by the end of the tax year, and you have to be under the income limits, which we will get to in a minute. That is basically it. The government's own economists estimate that around 34 million seniors will qualify. This is not a loophole for a lucky few. This is most retired Americans. And there is a bonus tucked inside it that almost nobody talks about. Because this deduction lowers your taxable income, it can quietly pull some of your Social Security back out of the taxable zone. A lot of retirees are shocked to learn that their Social Security check gets taxed at all, but above certain income levels, it does. By shaving your income down, this new deduction can shrink the slice of your Social Security that Uncle Sam counts. So it is not just $6,000 off the top. For some households, it also softens the tax on the benefit they worked 40 years to earn. 2 wins from 1 birthday. Now, I said there are income limits, and I have been dangling that word line for a few minutes now. This is where the good news meets the fine print, and where careful people either keep this money or quietly lose it. So let me show you exactly where that line sits. Here's the catch, and I want you to hold on to these numbers because they are the whole game. The full deduction is yours as long as your income stays under $75,000 if you are single, or $150,000 if you are married filing jointly. Under the line, you get all of it. Simple. Go over that line and the coupon starts to melt. For every dollar of income above the threshold, the deduction shrinks by 6 cents. 6 cents does not sound like much, but it adds up fast, and it keeps going until the whole thing is gone. For a single filer, the $6,000 is completely wiped out once your income hits $175,000. For a couple, the $12,000 is gone at $250,000. In between, you are in the fade zone, getting some of it, losing the rest, usually without realizing it is happening. And here is the piece that trips people. The income number that matters here is not just your salary or your pension. It is basically your total income for the year, the whole pile. Your pension, your withdrawals, your interest, your capital gains, your taxable Social Security, all of it added up. Tax people call it your modified adjusted gross income. But you can just think of it as everything that landed on your tax return this year. Which means the size of this coupon is not fixed. It moves. It moves with the choices you make about when to pull money out. And that is where the mistake lives. Let me make this real with a couple. Jean and Barbara, both 66, both retired. On paper, they are a perfect fit for the full $12,000 deduction. Their normal income, the pension, and a modest withdrawal lands them comfortably under $150,000. If they do nothing unusual, they keep the whole coupon. Then Jean reads an article about Roth conversions, and it is good advice on its own. He decides to convert $40,000 from his traditional IRA into a Roth this year. Smart long-term move. But that $40,000 conversion counts as income the year he does it. It stacks right on top of everything else and shoves their total income up over the line, deep into the fade zone. And just like that, most of their $12,000 deduction evaporates. The conversion might still be worth doing, but Jean had no idea he was paying for it twice, once in tax on the conversion, and again by melting a deduction he did not even know he was standing on. It is not just Roth conversions. Picture the same trapdoor under 4 very normal moves. You take a big one-time withdrawal to pay for a new roof or a truck. You hit the age where required minimum distributions kick in and the government forces money out of your IRA, whether you want it or not. You finally sell the rental property or a chunk of stock that has grown for 20 years, and the gain lands all in 1 year. Every one of those is a spike. Every one of those can push you over the line. And none of them come with a warning label that says, by the way, this just cost you your senior deduction. So why does this catch so many sharp, careful people off guard? 3 reasons, and they compound. The first is that it is invisible until the bill arrives. You do not feel yourself crossing the line in the moment you convert the IRA or sell the stock. There is no alarm, no letter, no phone call. You find out months later when the return is done, if you find out at all. Most people never connect the two. They just see a slightly bigger tax bill and shrug. The second is that it hides inside one-time events. This is not a mistake you make every day. It is a mistake you make in the 1 year you do something big, which is exactly the year you are least likely to be watching this particular line. The roof, the sale, the conversion. Rare enough that you are not on guard, common enough that it happens to almost everybody eventually. And the third reason is the clock. I owe you the honest framing here, so listen closely. This deduction is not a penalty when it fades. Going over the line does not make you worse off than before the law existed. It just means you get less of a new gift, or none of it. But here is the sting. This gift is temporary. As the law is written today, the senior deduction only runs through the year 2028. 4 tax years, and then, unless Congress extends it, it is gone for everyone. So the years to be careful with that line are not someday. They are right now, while the coupon still exists to protect. So how do you actually keep this money? The good news is you do not need anything fancy. You just need to manage that one number, your total income, around the line. Here is how, in plain steps. First, spread out the big moves instead of stacking them into 1 year. Gene did not have to convert $40,000 all at once. He could have converted 20 this year and 20 next year, kept his income under the line both years, and quite possibly saved the full deduction each time. Same with a large withdrawal. If you can split it across 2 calendar years instead of 1, you often keep yourself under the threshold on both. Second, if you are old enough to be taking required distributions and you give to charity, look at something called a qualified charitable distribution. It lets you send money straight from your IRA to a charity, and that amount does not count in the income number that controls this deduction. You give the way you already planned to give, and you keep your income down at the same time. Third, time your gains. If you know you are going to sell the rental or trim a big stock position, look at which year you do it. Landing that gain in a year your other income is already low can be the difference between keeping the coupon and melting it. And fourth, if you are married and only one of you is 65 so far, just know the second $6,000 unlocks the year your spouse turns 65 too. It is worth knowing which year your household jumps from 1 coupon to 2, so you can plan the big moves around it. Spread the income, give straight from the IRA, time the gains, mind the birthdays. None of it is hard. All of it is invisible if nobody tells you the line is there. If no one had ever told you this coupon existed, if this is the first time anyone laid out where that income line sits, do me one quick favor. Hit the like button and subscribe, so the next retiree about to convert an IRA without checking the line gets to see this first. That is the whole reason Walter does this. And here is your one job tonight. You do not have to fix anything. You do not have to call your accountant. Just pull last year's tax return and find your income number, the total, near the top of the form. Then see how much room sits between that number and $75,000 if you are single, or $150,000 if you are married. That gap is the most useful number in your whole retirement right now, because it tells you exactly how much you can convert or withdraw this year before you start handing the $6,000 back. Most people have never once looked for that line. You will have found it in 5 minutes. Now, Everything I've walked through tonight is the general rule, not your personal tax return. Your exact income, your state, your mix of accounts, and how these pieces fit together are yours alone. And a good tax professional can run your real numbers before you make any big move. But the shape does not change. There is a gift on the table worth up to $6,000 a person. It is only here through 2028, and it sits on a line that one careless year can cross. Know where your line is, and the money stays yours.